Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
This is indeed the Wealth is in the Details podcast with your host, Peter Raskin. I'm Patrice Sikora. Today, we will revisit a topic that really is important for the small business owner. Now, Peter, you did a show on this topic, but it was more than 3 years ago. Episode 32. Can't believe 3 years ago was 32. But time flies, and I imagine your many new listeners since then never heard that one. And others may want a refresher. So talk to me about episode 32 and what has changed since then.
Yeah, well, it does feel like a long time ago. There's been a lot that's gone on since early 2020. The retirement rules haven't really changed that much. There's been some small changes which are important for participants and for sponsors of plans. But I think the big difference for me is just it's a completely different environment for a lot of small businesses. Since 2020. Back then we were just starting. The pandemic, it was rearing its ugly head, and we had no idea what was ahead of us. And so it was really a different business environment, a different world. And I think that's the primary difference between then and now. I think now many, not all, but many business owners are really struggling to attract and retain employees, especially their key employees. It's a real problem. And don't you see that?
I hear about it, and I do know people who are looking for work and they can't find it. So I don't know where the disconnect is there.
Yeah, I think certainly it depends upon the industry. It's certainly very much industry dependent.
Right.
But we're hearing that amongst a lot of service businesses that they just can't find help, and it's just it seems to be a constant struggle for a lot of small businesses. I think the small business owner is also they now see that they've always experienced it, they've seen it before, but I think it's more tangible. They see the risk in their own business. For many small business owners that are building an asset that they might want at some point to sell, in the future, I think they understand that the diversification of their overall family wealth is really important. And, many of them are looking to set aside some assets in something different than their business.
Right.
Not that they don't have confidence in their business. All that's good, but they're looking to diversify, and they're looking to be in an asset that's protected and can accumulate in a tax advantage way, and that's retirement plans. Many of our clients are service businesses. Doctors, lawyers, engineers, consultants, and they pay a business that pays them a high income. But may have, a limited value upon sale. Mm-hmm. It may have some value, but they're not selling it for the gazillions. It's just not happening. So these service providers and professionals are aware that they just need to save for a day that will come when they might not be working, or at least not working as hard. And, that day might happen when they're 50, 60, 70, or 80, and it may not be choice. It may not be by choice, so health can get in the way, and also lifestyle gets in the way. So they may at one point want to slow down or exit. My experience is nevertheless is that they'll likely want income that goes beyond Social Security. And so these small business qualified retirement plans are a good alternative to attract and retain employees, but also for the business owner to accumulate personal assets.
Peter, you said qualified retirement plan. Explain that, please.
Yeah, so I just think it's an important distinction. Let's start with these basics. A qualified retirement plan refers to an employer-sponsored retirement plan that satisfies a lot of requirements from the Internal Revenue Code. And because of that, the plan sponsor and employees receive tax-deferred treatment. It's tax advantaged. And so that's what we mean by qualified retirement plan.
And let me guess, there are two big categories here. You've got defined benefit pension plans and defined contribution plans.
Exactly. Those are the big categories that I wanted to discuss today. And I think it's just helpful to give our listeners just a sense of how these plans work. So a defined benefit plan is a retirement plan for the benefit of participants, meaning employees of the company. In this strategy, in this kind of vehicle, what we do is we take a look at an employee's income and their age, and the employer is making a promise to provide them a pension income at their retirement age. So let's say 65 or 67. And there's a formula. So the defined benefit pension plan may say that the employee will retire at 67, receiving 30, 40, 50% of their income, of their last, the average of their last 3 highest years, and they will receive that income for life. And so the way defined benefit plans are structured is we define the benefit, that future benefit, and then we need to fund. The plan sponsor needs to set aside monies each and every year so that there is money in this pool that can be used to fund this retirement benefit at that participant's age.
Nobody gets a pension anymore, Peter.
Very few people get a pension. Absolutely the case. But I think it's important to know that for the small business owner, these are possible. There are advantages and certainly disadvantages of these pension plans. The big advantage of these pension plans for the small business, I'm not talking about the big mega company. Mm-hmm. They all had pension plans. Most of them don't have them anymore, right? Or they're frozen. But the advantages for the small business owner is that the employer needs to set aside very large contributions to provide that benefit for those older employees.
Right.
So in order to fund something that the employees promised in 10, 15 years, the employer needs to sock away a lot of money each and every year. And so because of that, defined pension plans allow for very large contributions. And we're talking about in the hundreds of thousands of dollars. So it can be very enriching. For younger employees, a defined benefit plan can also be advantageous, but the funding requirement is much, much lower because they've got many years before retirement. These employee funding limits are really very, very very large within the defined benefit plan, much larger than defined contribution plans. And that tends to be the big advantage of those, what we call those DB plans. There are lots of disadvantages. Number one, funding is truly required. And so there's very little flexibility for the plan sponsor. If they got an older employee that's retiring in 10 years and they've designed a benefit around that, they need to fund it. The funding amounts are dependent really on a couple of things out of the employer sponsor's control, and that would be number one, interest rates in the world that we live in as of that year, and then investment results from the previous year. If the investment portfolio, the pension plan is invested in stocks and bonds, and stocks and bonds do poorly that year, the calculation from an actuary might suggest that the funding requirement is much, much larger in that year. And if interest rates go down, the actuary does a calculation using that lower interest rate, meaning they're generating lower returns in the future, and therefore they need to contribute more to the plan. So the funding requirements are a little bit out of the employer sponsor's control, and the plan benefits and funding, while they can be increased and decreased, there's limited flexibility. in making changes to that funding. Those are big disadvantages for a lot of employers. Another concern, especially for the small business owner, is that upon plan termination, which might happen in the future when the owner retires, there may be unknown costs at the very end because there may be an unfunded benefit that needs to be funded.
Right.
So that's a potential cost. You also have slightly higher cost to administer, and that's due really to the actuarial calculations that are required each and every year. These are government mandates. And lastly, the last advantage I just want to mention is employees don't necessarily understand how these plans work. The employees get an annual statement that tells them what their benefit is, but oftentimes they don't see a dollar value there. There are plans, we call them cash balance plans, that do provide that account balance. But for the most part, employees don't really understand how they work. And I've talked to many, many clients that have these plans, and they just don't understand it. And I think there's something to be said for if you're the employer, you're providing this benefit to attract and retain employees. And if they don't understand what they have, that's not meeting that objective.
Oh, now let me ask you a question, because a number of years ago, we had some of the big corporations with the defined pension plans. They couldn't meet the plan needs, and it was the Pension Benefit Guaranty Corporation that stepped in, the federal program, to cover. Now, do small business owners have that safety net?
Oh, they do. Yeah. Matter of fact, they have to pay a premium for that each and every year. So yes, they have that safety net as well. It's a limited benefit for many rank and file employees. It would be covered, but for the highly compensated owners, for example, there may be limited benefits there.
I got it. Okay. All right. So defined contribution plans. What are those? How do they work?
Yeah, so it's really the in a sense the opposite. In the defined benefit plan, we're defining our contribution by the benefit that's been promised. In a defined contribution plan, we're defining your benefit is determined by the contributions that are made to the plan each and every year and the investment earnings on those plan assets. So it's a big difference. It's really the reverse. But there's a lot of advantages to the defined contribution plans. Number one, there's great flexibility. So the employer really has discretion in most of these defined contribution plans to stop most or all contributions, depending upon how the plan is designed. And a lot of small business owners really want that flexibility. And I can certainly understand why. It's nice to know that there's not a required contribution each year. So there's discretion. An employee can elect, another advantage is an employee can elect or decline making contributions to the plan. A defined contribution plan can offer a salary deferral option for employees. Think of a 401k plan or a 403b plan. They allow employees to make contributions for their own benefit. These are participant contributions, and because they're contributing, they have both an emotional interest in this asset, so they're really vested in it, and technically, if they're making contributions, they own it, and that's great for employees. They like that.
Makes you feel good. You've accomplished something. Yeah.
Absolutely. You're saving for yourself, and it's really important. And it's great to see your money accumulate and grow. It feels good.
Yeah.
It doesn't feel good when markets decline and your account value goes down in value.
And that's when you don't look at it.
Exactly. There's another advantage for defined contribution plans. Typically, there's a little bit lower cost to administer than defined benefit plans. So lower cost to entry, basically. They're less complicated from that perspective. Another big advantage is the employees everyone's familiar with 401k plans and profit sharing plans. They're just used to them in today's age. And most plans are structured with a record keeper, kind of a custodian of those assets that allows the employees to see their accounts daily online. They get quarterly statements typically. And as I mentioned earlier, the employee can control the investment accounts. They make those decisions. Given that flexibility, I think there are some disadvantages to both employer and employee, but they're I think, fairly minor. Number one, employees, I see this as both an advantage and disadvantage. Employees direct their own investments. Now, the good news is employees can have control, but the bad news is they may not be very good investors.
Yes.
and that's a problem. If an employee invests in something that's too high risk, the markets go down, their account value goes down, and then they sell and move into something with less risk. They basically take that loss. And that's a real problem for employees. There are solutions around that, but I think employees really need to either seek advice about how those are invested, or choose balanced funds or target date funds to avoid that long-term kind of bad decision-making risk. I see that as I'll put that in the disadvantage category.
Yeah.
And the other disadvantage is for both the employee and the employer, is that there are lower limits. So there are annual limits to how much can be contributed to benefit employees. And these defined contribution plans have lower limits than really defined benefit pension plans. And for those employees that really have a goal to make very large contributions, maybe the defined benefit plan, the pension plan, may be better for them. That's part of our conversation.
That's it. And I love this explanation. I appreciate that. But now I'm going to test you. All right. I'm going to give you some small business examples, and I want you to tell me what kind of retirement plan might be appropriate. Okay.
Sounds great.
Here we go. The first one, an employer with 2 employees. The owner employee, 55 years old, consultant, has a 30-year-old assistant earning $75,000. The owner, though, is currently making $500,000 a year and plans to retire at 65. She wants to save at least $100,000 per year, and she is confident she can do that. And she doesn't mind making some retirement contributions to benefit her employee. Go for it.
Yeah, this is a perfect case for a defined benefit pension plan. And these situations don't come around, every day, but we definitely see them a lot. Let's just run down why this employer may choose a defined benefit pension plan. Number one, they can probably meet their saving objective with a defined benefit pension plan, but they will not meet that saving objective with a defined contribution plan, a 401k profit sharing plan. It won't happen. And it sounds like this employer is confident that she has the cash flow to commit to that level of savings, if not more, each and every year. And that's a vital kind of check the box. I want to make sure when we're talking to our clients, they're feeling like they have cash flow to meet this goal. And I think also I want to make sure that this plan is going to be in place for at least 5 years. I think that's a safe bet. I think the IRS wants to make sure these are permanent plans, and they don't want a plan set up for just a year or two, unless there are crazy circumstances, but it just raises a red flag with the IRS. Right. So you really have to have a long-term commitment for it. Because the employee, not the owner, because the employee is young, not that 55 is old, the 30-year-old is younger than the 55-year-old, the contributions for that employee, that participant, are really relatively small, because they've got so many years before they retire. And the contributions are relatively small compared to the $100,000 contribution that might be required. This contribution might be $3,000, $4,000, or $5,000. And that may be within, and I think the employer will also like that there's a vesting schedule. So that contribution that's made, if that employee leaves or terminates after a year, 2 or 3, they won't be receiving all of their benefit that's been contributed on their behalf. Okay. And the cost of administration for a plan of this size with the goal seems to me to be relatively small. I wouldn't be too concerned about that cost of administration. It's just a cost of doing business. It's a deductible business expense. We're not talking about, we're talking about costs in the first year of, $3,000 to $4,000, $5,000, and then, $2,500, $3,000 year after. Thereafter. So it seems reasonable based upon the deductions that employer could see in their high tax bracket.
All right. And as you say, cost of doing business.
Yeah, right.
Hi, this is Catherine Broy from the Raskin Planning Group. Apologies for the interruption. Thanks so much for listening to Wealth is in the Details. We hope you're enjoying it so far. If you have any questions or would like to talk more about this topic, please visit our website at www.raskinplanning.com. Look for the podcast's show notes and connect with us via social media.
All right. Let's switch it up a bit. Same 55-year-old, currently making in excess of $500,000, but is less confident about the savings and the earnings, capacity that she's got. She has a total of 5 employees, all under the age of 40, earning less than $100,000. What do you think?
Yeah, so this may not work out perfectly, but in a lot of cases, it does. We've got some flexibility of design. But my thought would be this employer might want to take a look at a defined benefit pension plan and pair it with a 401k salary deferral plan. So a pension plan can be paired with a defined contribution plan.
Okay.
And so I don't want to get into the weeds here, but I do need to kind of describe that. So we got 2 separate plans, and for I think most people are familiar with 401k plans, but they are completely flexible. The owner can save up to $30,000 per year because she's over age 50. She can save over $30,000 per year into the 401k piece of it, right. But she doesn't need to contribute. So this year she may very well want to contribute. She can afford it, but business turns against her, and she doesn't have that flexibility. She can turn the salary deferral contributions off, and the employees can continue to make those salary deferral contributions if they want, but they don't need to.
Got it. It's an option.
It's an option. It's flexible. Right. There may be some small contributions that the employer will have to make for those participants that do participate in the 401k plan, but they're on the smaller side. So the big commitment has been reduced for that employer.
Mm-hmm. Okay.
Now, if we design the defined benefit plan, now we're talking about the other plan that we would implement. If she feels comfortable making a, let's say, $70,000 savings contribution to that plan, and is confident that year in and year out, that's something she could do. She could reduce it a little bit if she needed to. The plan allows it, and she could also maybe increase it if she needs to. But the defined benefit plan can be designed with a lower benefit than the previous employer. So we can make some adjustments to that. So by doing 2 plans, she's got more flexibility than she had before. She's contributing a similar amount now, and because she has 5 other employees, I think she'll definitely need to feel comfortable making those smaller contributions for each employee, both in the 401k and the pension plan. And as long as she's comfortable with that, I think she's going to be fine. She also will have a vesting schedule on the defined benefit pension contribution. So overall, this plan would do a long way to helping this employer meet their personal objectives of saving, but also attract and retain, valuable employees that are helping her make a lot of money.
If you pair 2 plans like that, does the administration get complicated?
As long as you've got both plans administered by one administrator. In these plans, you would hire an administrator. We call them a third-party administrator. And they do all the bookkeeping, the compliance work, the tax filings, the form filings that need to happen. And if you've got one company doing it, it's not that complicated.
Okay.
For the employer.
Right. Okay. All right. I got another one for you. 50-year-old dentist establishing a retirement plan. This dentist earns more than $400,000. She wants to work another 15 years if her health allows. Ideally, she wants to save in excess of $60,000 a year, but wants some wiggle room there, some flexibility. Now, she has 5 employees, all earning less, all younger than 40, and she doesn't mind making small contributions to help them save. What should she do?
Yeah, so because that sounds like flexibility is really important to this sponsor, I'm going to recommend a 401k plan with profit sharing. And what that
Oh.
means, so what that means is the employer and all the participants can contribute to the 401k piece of it. Again, they can defer up to $30,000 if they're over age 50, $22,500 if they're younger than age 50. So that's the salary deferral piece.
Mm-hmm.
But they don't have to. No one has to contribute to the 401k side. If there are profits at the end of the year, if there's capacity for additional savings, the employer can determine how much and can make contributions to for the employee's benefit, including herself, at certain levels. And this kind of profit sharing plan would have an allocation schedule. We call it new comparability schedule. The profit sharing contribution percentage amount is going to be based on, it's an actuarial calculation based upon their earnings, based upon their age, and based upon the group that they are in. Now, if you've got 6 employees in this example, you can have 6 different groupings of employees. So each employee can get a different allocation. So maybe she's got, herself, maybe she wants the most contribution, the largest percentage. And maybe there's a couple of employees that seem to be key to her that did a really good job that year.
Mm-hmm.
And she might want to put those into a second group, maybe, but less of a contribution than what she would receive. And then there may be a third group or a fourth group that would receive even lower contributions. And then the employer allocates appropriately to each participant. Now, there's calculations that have to be made. An actuary needs to be involved. Actually, it's not really an actuary, but there is an actuarial-like test that needs to happen that makes sure that the plan is in compliance. But this is a very flexible schedule. The employer doesn't need to make a profit-sharing contribution. The employees don't need to make salary deferral contributions. The employer can change their allocations throughout the year as long as they're meeting that test. And that test is really going to be based upon demographics of the company. So, as the employees change, some become older, some new employees might be hired that are younger. This test can change. So it's not the same each and every year, but it gives the employer tremendous flexibility. So I really like 401k plan with a new comparability profit sharing allocation for this dentist that you've described.
All right. It seems to me like with something like that, because there are so many you don't have to's, you really have to be, if you are an employee, you've got to be pretty committed to your own retirement savings. You've got to at least be putting something aside yourself.
I think that's so key, Patrice, and I'm so glad you mentioned that. Both employees, and an owner that working in the company is an employee. Right. Everyone needs to be concerned about their own personal planning. And I'll talk, basically we start with planning for both the business owner and employees. What do you want to achieve? When do you want to achieve it? And that's vital.
Yeah. Okay. Got another one for you. This time it's a 45-year-old landscaper, 10 employees, 5 full-time, 5 seasonal, limited savings capacity. He does want to save more for himself, and he does want to offer something for his full-time employees. What do you think here?
I think maybe 2 plans would be appropriate, or one of 2 plans would be appropriate. Okay. One would be, just a traditional 401k plan. These you can set up 401k plans for one employee. So this would be a small company, but they could absolutely do it. There'd be tremendous flexibility. The employer could contribute up to $22,500 per year into the plan. Plus, when they turn age 50, they can contribute another $7,500. It's called a catch-up contribution. So that would be beneficial. Really, their only commitment to the employees might be a 4% matching contribution. And so if employee contributes, $1, the employer will contribute $1 up to 5% of compensation. And so that the match, when we do the math, is 4%. There's a 4% matching employer commitment if employees contribute at least 5%.
Okay.
Now that matching contribution is 100% vested. But if the employer is comfortable with the cost of a 401k plan, again, it's not that much. They're comfortable with the matching. It seems to be like it might be a worthwhile experience for them. They can also, at some point, if there are more profits, they can make discretionary profit sharing contributions. And the current limits there are $66,000 per participant. So that's the limit. They may not be able to make a $66,000 contribution for an employee that makes $50,000, but there are the ability to make fairly significant contributions for the benefit of employees and the employer, plus an extra $7,500 catch-up. So you can get into your over $70,000 per year for the employer if they want. So I think that's a reasonable option for them. Another option, really kind of a starter plan. And there are not every company would be eligible for this, but an employer, a small employer with less than 100 employees can establish a simple IRA. And a simple IRA is kind of really that. It's basically an IRA that allows employees to contribute a certain amount to the plan each year. Now, so it looks and feels a lot like a 401k plan, but it doesn't have the administrative costs. There's no tax filings. It's a pre-approved document that the IRS has established. Employees can contribute up to $15,500 per year. If they're under age 50, if they're over age 50, they can contribute an additional $3,500 per year. So that is a nice feature. Again, no cost. There's no profit sharing contributions.
Okay.
So I think that's an issue. There would be a mandatory employer matching contribution, in this case of 3% per year, that's 100% vested. So it's a little bit less than the 401k plan. The big advantage of the simple, very little cost of administration. The downside is it doesn't allow the employees, including the employer, to contribute as much. Now, I didn't mention this before, but I think it's important to understand that those seasonal employees may never become eligible in the 401k plan.
Right.
Because they just may not meet the eligibility requirements. And they may not be eligible ever meet those requirements in the simple IRA, but there's a greater likelihood that they would with the simple IRA. Mm-hmm. So I don't want to go into the details of eligibility because we'd be here another hour or two. But suffice it to say that those seasonal employees may not become eligible for either plan. And I think you're able to be a little bit more restrictive with the 401k plan, in my experience.
Okay. Well, let's move up to a bigger organization. How about something that's got 50 to 100 employees? Where do you go?
Yeah. So here, I see right now, especially those companies are really focusing on 401k plans with a matching contributions. Sometimes there'll be a safe harbor plan that's utilized, and that allows all employees to contribute up as much as they want, salary deferral, without any testing requirements. And if you don't have a safe harbor plan, there could be testing. Highly compensated employees may not be able to contribute as much as they want. Mm-hmm. That's the problem, especially if you've got a labor force that may not join the plan as readily as another labor force. If you've got a highly paid employees, technology people, maybe they're kind of more likely to contribute to a plan than a small manufacturing plant with lower compensated employees. So that can be a problem for that employer. Mm-hmm. So basically a 401k plan, sometimes the match is discretionary, sometimes it's safe harbor, so it's not. I'm seeing more and more adoption of automatic enrollment features. Yes. and sometimes automatic escalation, meaning employees hired, and once they meet their eligibility requirements, they're automatically join the plan. They can opt out if they want. Right. And then automatically each year, their salary deferral contributions increase. And so it increases the chance that the employee is going to be a participant and will help them really meet their financial goals. It's more likely that they will. Over time, these features, automatic enrollment and automatic escalation, help with financial wellness for all employees. So that's what I see for the larger employees. They don't get as much involved in profit sharing and defined benefit pension plans any longer. That's not what I see very often.
What I like about this discussion, Peter, is the fact that you looked at it from the business owner, but also the non-business owner's point of view, the employee's point of view. And it really gives you a sense of, well, this is what my boss is thinking about. This is what they have to look at. And this is why that company may be offering a different plan from that company with different features.
Yeah. I hope the non-business owner listener feels that this discussion is helpful because, I want to stress to all listeners that when you're considering any financial strategy, you start with your own objectives. As I said before, you got to think about your own wants and needs. And so, when we're talking about retirement planning or investments or estate planning, tax planning, we just start with our objectives. And in the situations I've described, I've started with the employer's objectives, the plan sponsor. Mm-hmm. That's what we need to start. And in my opinion, we start at the Raskin Planning Group with a comprehensive review of that business owner's total picture, their overall goals and objectives, both personal and business. And just like we do for the employees, for non-business owners, whether they're executives or individuals that are retired, we start with what are you trying to achieve and when do you want to achieve it? It's that true. To me, it's that easy. And, when our listeners do that, we think they get the best results.
You're absolutely right. But sometimes it's getting people to sit down and think about those things that is the most difficult part. And with that in mind, how can listeners reach you, Peter, so you can get them to sit down and think about these things?
The best way to reach us is through our website. It's raskinplanning.com. And there is our contact information, links to find out how to reach us, and lots of resources as well on the website. So glad to chat with people that are concerned about their retirement planning. Glad to chat with business owners looking to explore different strategies for them.
All right. And all you listeners out there, follow or subscribe to Peter's podcast. The Wealth is in the Details. This will mean you don't miss an episode, and share with others as well. Thanks for being with us.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corp. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corp., a broker-dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln Affiliates and other fine companies. Raskin Planning Group is a marketing name for registered representatives of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.